Taking a while. I'm getting worried. What do you think, Ron?
I've never used this system, so I'm not familiar with it.
Huh.
You have your camera turned on?
Yeah. What the heck?
Well, it's got something to do with the camera there because Karen's with us. Good morning, Karen.
Let me see if I can get some tech support here. Do you see some people signing up already?
Yeah, I see Karen's with us. Rosa's with us.
Okay.
Tell us where you're checking in from, if you would. What city, state, whatever.
I cannot, let me see, someone's.
Morning, Richard.
Let me see if I can get some help here, guys.
Michelle, you might want to turn off your camera and then turn it back on again. There you are. Half Moon Bay, Mission Viejo, Diamond Bar, Pacifica. And now turn your audio off and turn that back on, Michelle. Okay. Now we see you. Tennessee's in the house.
Should I unplug this?
Now I hear you. You're with us.
No, I've already been.
Florida's in the house. Nice. Tennessee. California, Northern Virginia.
It's my this.
We hear you, Michelle.
Yeah. No. I did kind of need that though. Okay. I'm having technical difficulties.
We hear you.
It's okay. You hear me? All right.
We hear you. We see you.
Hello, everybody. Okay, so I am just going to introduce Ron because my presentation is just saying it's starting an event. This may take up to 15 minutes. I don't know what's happening. So I could either start and stop again, but I think I would lose everybody. Or what do you think?
Yeah,
Ron?
probably.
So what I'm going to do is let's just talk about it because I'm not going to have any slides. How's that?
We're all good.
Okay, cool. All right, everybody. Thank you for joining, and I apologize for my my technical issues. At least you guys can hear me, and can you see me clearly? Ron?
I see you, but it looks like in some of the notes that they're only seeing me, which that's not a good thing. No one really wants to see me. They want to see you.
Oh, can everybody see me? Can somebody text me if you can see me?
Just put it in the chat if you would.
And Ron
Okay,
can
Rick
read
says he
it
only
because
sees me.
oh, dang it. I don't know what's happening. Okay, well, this is just the way it's going to be. Sorry you can't see me, everybody. I'm Michelle with the State Legal Plan. I'm glad you can see Ron because he is our speaker, our guest speaker of the day. And a little bit about Ron Siegel. Ron is a Chapman University graduate with degrees in accounting, marketing, and management. He's built a distinguished career blending entrepreneurship, real estate, and financial expertise. After launching and selling multiple businesses in real estate and finance, after launching and selling many businesses in the 80s and 90s, he joined Merrill Lynch, earning a Series 7 and 66 and insurance licenses. With decades of experience investing in and financing real estate, Ron has guided countless families through purchasing and refinancing homes, including FHA, VA, jumbo, and reverse mortgage loans. Since 2010, he has hosted over 2,350 shows as a consumer advocate and real estate expert on the radio, educating listeners on topics from home financing and estate planning to wealth management and retirement strategies. So Ron has been around for a while, like me. He's a local Orange Countyan, and he is very experienced in all these things we're going to talk about today. But our focus today is the reverse mortgage and estate planning combined. It's very important to know some of these reverse mortgage loans are confusing. To me, they're confusing. So Ron's going to break down some of the myths that that people think when they get a reverse mortgage. And then I'm going to go ahead and pull up the slideshow in a different format. So I can follow along and make sure that we're hitting all the points that we've put together on the slideshow. And again, I apologize that I cannot show you the slideshow due to issues I'm having on my end. So let's go ahead and get started and debunk some of these myths. Thanks for joining us, Ron.
My pleasure. I've got my slideshow up on here. I don't know how to make it where it's on the screen if that's doable.
You know, my screen is kind of blacked out. It's grayed out, and I have no idea. I can't click any buttons or do anything with it. And I'm afraid if I leave, it's just going to, I'm going to lose everybody. So I have no control over what's happening here. So I
We'll walk through it. We'll talk through it.
Okay, cool. Okay, myth number one, the lender owns the home.
Not true. Lender does not own the home. The lender never owns the home. It's just like any other lien on the property. So it's a lien on the property, just like any other lien. If you get a traditional mortgage, there's a lien on the property. If you get a reverse mortgage, there's a lien on the property. If you get a traditional mortgage, you have 100% control of the property. With a reverse mortgage, you have 100% control of the property. You can sell it, you can refinance it, you can leave it to your heirs, anything else. So the lender has no control other than just a straight lien on the property.
That's so good to know, because a lot of people think I've given my home to the reverse mortgage company because they're giving me money now. So it's not mine anymore.
So the reason that's one of the big myths of the product is prior to 1985, that was the way the loan was, is that you were basically giving your property to somebody else for a fixed price with the agreement that you could live there the rest of your life. So that's the way the product worked up until 1985, and it changed back then. Unfortunately, it didn't. The connotation of how bad a product it was back then never got fixed. So that was a big issue.
Guys, I'm live now.
I don't know what happened, but I just got the slideshow to work on my side here.
Oh, happy day. That was a very nerve-wracking. This has been very nerve-wracking so far. I'm all flustered now, but we're going to continue because we must. The show must go on. Okay, so thank you for that. All right, here we go. Okay, so once loan proceeds are received, you pay taxes on them.
That's another one. I don't know if this works, but so that is not true. That once again, you don't pay taxes on them. It's just like any other loan. If you go and do a mortgage, or you get a home equity line of credit or something along those lines, you pay taxes based on income. You don't pay taxes on a debt. So, I mean, if you went and charged up your credit card, is there a taxable event there? No. So when you take it out a reverse mortgage, there's no taxable event. It's just a loan on the property that has to be paid back at some point in time.
Mm-hmm. Okay, right.
But again, I don't give legal advice, and I don't give tax advice. I just know about loans.
Right, and you want to make sure to contact your financial advisors and any government agency, and just make sure that when you get into a reverse mortgage, that you've covered all your bases.
Exactly.
Okay, so myth number 3: the borrower is restricted on how to use the loan proceeds.
You can do anything you want. Well, I guess I should have hit the button first. You can do anything you want. So loan proceeds. Now, there was a problem with the loan some time ago, and it's been fixed. So what the problem was at one point in time was our seniors would get this massive amount of money, and massive is different for everybody. But we all know what happens when somebody wins the lottery, right? They're broke within 5 years. The reason is they get a huge amount of money, and all of a sudden they've got all kinds of friends, family, people that they don't know come out of the woodworks, and they end up spending it all. So what's happened, the way the government fixed that, and the majority of reverse mortgages are what we call a home equity conversion mortgage. It's an FHA loan, so it is controlled by a government regulation. And one of the things that they did is they said, okay, you're going to only get a small amount of the proceeds in the first 12 months. And that's done based on a formula that I don't want to bore you with, but you get a percentage of it. Then after 12 months, then you can get a lump sum of a larger amount if you're taking a lump sum loan. So basically, and that's on the what they call the home equity conversion mortgage, or the FHA reverse. There are reverse mortgages out there that are proprietary, that'll go up to much larger loan limits that work a little bit different. And I can explain that if you want. But the idea is, if you want to go on vacation, go on vacation. If you want to do home improvement, do that. If you want to give some gifts to your grandkids or kids, it's up to you. You can do whatever you want.
I love that. Okay, myth number 4, I think we're on 4. The home must be free and clear of any existing mortgages.
Once again, that is not true. So I would say at least 3/4 of the reverse mortgages I've done have had loans on them. And, we just, now there is a limit to the amount, because there's not going to be any payments required, keyword required, on a reverse mortgage. So there are limits to the amount that you can get as far as liquidity of the reverse mortgage. But I would say, again, it doesn't have to be free and clear. You can do whatever you want with the money. And believe it or not, more often than not, most of the people that I deal with do the reverse mortgage as a financial planning tool not a last resort item.
Now, is that existing mortgage paid off when they do a reverse mortgage?
In most instances, yes, but there is a company that's come out now with a reverse mortgage second, which is a
Oh,
great tool for those people that have, the 2 and 3% mortgages. I
ooh.
have one that I'm working on right now that we're going to get a reverse second, and that second is going to be enough, give this person enough liquidity to pay the payment on the first. So even though the first is a traditional forward mortgage, the second has the liquidity to pay off the first, and she's not going to have any payments at all.
Oh my God, that's fantastic.
But again,
So
it's another one of those things that I talk about, that it's done for financial planning purposes more than hardship.
I love that. So on that same note, let me ask you a question. Based on the how much can somebody usually do a reverse mortgage on? Is it based on 60% of the value of the property, or what is that rule now?
There's a formula that you go into, and it's you're basically it changes based on the value of the property. It'll also change based on the youngest borrower's age. So it's basically determining how long can we anticipate, based on actuarial tables, is the mortgage going to be in existence. So if you look at an 85-year-old, they're going to get a more liquidity than a 62-year-old. And it's just because the 85-year-old, is,
Yeah.
as I put it, they're on the 10-yard line, and the 62-year-old's probably on the 35-yard line.
As my dad calls it, they're in the impact zone.
That's it. Right.
He calls it that. I love that.
Yep. That's exactly it.
So, is there a maximum amount for a reverse mortgage? Like let's say you have a $5 million house. I know this is off record. We don't have a slide on this, but
I actually did a reverse mortgage for a lady, and her house was actually worth 11 million, and we did a $4 million reverse. That was the cap. So it was a $4 million reverse, and actually it was done right around a little bit later than this when we did it, because her goal at the time, her house was free and clear, worth again 11 million. We did a $4 million reverse. She wanted to give each of her kids, she had 3 kids, she gave them each $1 million and put $1 million to do what she wanted with. But she got to see her kids enjoying that money. It was going to go to them anyway. So instead of them getting it after she was gone, she got to see her kids enjoy the money.
I love that. I love everything. I just love everything today, Ron.
It's a fun product because you're dealing with, late in life.
Yeah.
So it is a great product.
I think it's fabulous. I just think there's been so many bad myths about reverse mortgages, because back in the day when I was selling real estate, they were coming out and we're like, oh man, that's nasty. Why would somebody want to do this? Because it's eating up all their equity, and there's so many rules to it. And
well, that's another myth, right? That's another myth right there that we should talk about, Michelle.
Okay, let's do it.
So it's eating up all their equity. So when we get into our golden years, we've got, just for ease of analogy, you've got money in your right pocket, and you got money in your front left pocket. If you go to make a mortgage payment, if you don't have a reverse mortgage, you're going to pull money out of your left pocket to pay the mortgage, and that's going to go down. Now, what's happening is that money is going from your left pocket into, some of it's going into your right pocket, right? Because the principal part is still your money, so it still stays there. So if your equity is going down either in your investment portfolio, or it might go down in your real estate portfolio, but it kind of is a teeter-totter on both. So the reverse mortgage, it's using up some of your equity, but you're going to live, you had to eat, you had to pay your medical expenses, your health care, whatever. So you were going to spend money anyway, and that had to come from somewhere. Well, now you're not spending that because you've got you're saving money on the living part.
Mm-hmm. Right. And it's so valuable because people are sitting on these on their properties, which is the most valuable thing most of us have, but we're house rich and cash poor, and we're like barely eating. So I talked to a gal, she was barely surviving and she could barely buy food, but she had a $1.5 million house, and she's like, I can't fix it up. I don't have, I barely can eat because my medicine and all that. And I'm like, man, so this is the beauty of the reverse mortgage for so many people right now, especially in our older years where we just don't, Social Security is not cutting it for us anymore.
More
So,
month than money.
yeah, so I just think such great options people have these days. It's kind of like healthcare not healthcare, but all the technology. We're growing older. We have so many more stay well with all the great technology, and then we're running out of money. So if you've got your house, use it, enjoy the rest of your life, do things you want to do, go travel, have good food, go get that steak, so
you're in your golden
really
years.
Cool.
That's it. I did a reverse mortgage for my mom and dad, and they're both gone now. But my sister and I were the heirs, and our goal was, or our comment to them was, we want you to spend your last dime with your last breath. Go out and have a good time. One of the big things I hear all the time is the kids will say, we don't want to use up that equity because they're expecting that's going to be their inheritance. Well, it's mom and dad's money. Let them go and enjoy it. And Alan had a question here, Michelle, that we should throw out there. Reverse mortgages are for primary residence only, not rental properties.
Right. And you must be at least 62, right?
Well, there's some coming out now that they can on the FHA reverse on the HECM. Yes, it's 62. There are some coming out now that are 55 also. But again, you're going to get a lower loan to value or liquidity amount if you're that young.
Okay. That's nice. So, a lot of people think reverse mortgages are only for the poor, like this slide says, but that's like you said, a lot of people are using it just, for not just financial reasons, but just it's a smart thing to do.
Right. Well, but one of the things that we talk about with it is, where do you have your money, your retirement fund? So it's usually going to be in a 401k. It's in the stock market. It might be in the bond market as you're getting older. You're putting money in different areas. Well, here's the thing. Those markets go up and they go down. So the wise individual that's got a good team working with them, and I call it a household board of directors. You've got a lender, and you've got your attorneys and your estate people, and you've got your financial planners, the whole 9 yards. Well, they need to work together in looking at it and saying, okay, the stock or bond market, maybe that's down right now. We don't want to sell. We don't want to sell when the market's down. So let's take money out of our real estate portfolio and let's live off of that. Now, when the market goes back up, we're going to replace the money into the real estate portfolio. And that's a big tax advantage that very few people understand of the reverse mortgage. But the bottom line is that, when one goes up, the other goes down. You use it strategically instead of pulling money from your retirement plan, when you have to.
Smart. If I have a reverse mortgage, I don't need a living trust. Tell me about that.
Absolutely not. Absolutely not. So I'm a simple guy. So I basically say, if you have a house, you need a living trust. Mm-hmm. If you have assets, you need a living trust. If you have kids, you need a living trust, because there are so many benefits to the living trust that one of the big things is, guess what? If you don't have a living trust and you go and at some point in time, even George Burns found that we all pass on at some point. If you've got real estate, it's going to go into probate. Now, do you think the lender, when the reverse mortgage matures, and what I mean by matures is the last person leaves by choice or otherwise, the reverse mortgage becomes due. And they're going to give you 6 months automatically to restructure that, and they'll give you an automatic extension as long as you're communicating with them. And I dealt with that with my mom and dad's because I was the successor trustee. But the reverse mortgage company wants their money. And if the property is going through probate, well, not only do you have the expenses of probate, somebody's got to make the mortgage payment. And I just heard a case last week where a property was going into foreclosure because the mortgage company said, we can't wait any longer. And I hear that it's 18 to 24 months on probates. So, with the trust, you have the living trust, you're skipping the probate, and that's your expertise, Michelle, but you're not going into probate, so you can deal with the estate without that extra stress and that extra expense.
Right. Let me ask you a question. Let's say you owned your property free and clear, and you got this reverse mortgage, and you have all this money in the bank from the reverse mortgage, and you die. And the house is in a trust, but you have all this money in the bank, because you pulled it out. But in your house is in a trust, so there's no mortgage they need to pay, right?
If they took out a reverse mortgage, they have a lien that has to be paid off. And you can never owe more than the amount of the value of the property, as on the FHA reverse. You can never owe more. So it's not like they're going to come after the estate for any deficiencies. But you took the money out, you put it into the bank. Hopefully, and if you went through Ameristate, you're going to have that bank account's going to be in the trust. So it's just going to be one of the other assets that the trust deals with. So they may be taking that money to pay off the lien from the reverse mortgage, or you can sell the property and any extra equity goes into the estate. So you have all those options. But in this
case, there's no mortgage to be paid because it's a reverse mortgage. So when you said you got to pay the mortgage, but anyway, so I get that. I just was trying to make sure. I'm like, do I understand that right? Well, maybe if you had a primary first and then you got that second, you still got to pay that primary first mortgage.
Well, if you took cash out for the reverse, if you had the property free and clear, and say you got a reverse mortgage and you took a lump sum of $100,000, well, that lien is for $100,000 plus whatever interest is accrued. That has to be paid back.
Yeah. And they want their money within 6 months. So you got to figure out something. And at least if you have your property in a trust, you're not going to go through an 18 to 3-year probate.
Right.
And the reverse mortgage lender is going to be going, they're not, do they hang out for that long? I guess maybe they have to. I don't know.
No, they'll, if it looks like it's not going to settle. I have a case right now that we're dealing with that the property went into foreclosure.
Okay. So we just want to stay out of foreclosure, period, and probate, period. You want to stay out of probate because your house that is going through probate could also go through foreclosure because the reverse mortgage guy is like, hello, right?
And that's a scary thing because if you don't have somebody that knows how reverse mortgages work, believe it or not, the reverse mortgage company finds out that the last person that's living when they pass, if they pass on while there's still a reverse mortgage, the reverse mortgage company finds out about it practically before the mortuary. I got a letter from them, a condolence letter within like 3 days of my mom dying. And it was very, very nice. It was just a condolence letter. But they knew it. So, and then about 3 weeks later, they sent a note saying, hey, what are your plans on dealing with the property? Are you going to sell it? Are you going to refinance it? Are you going to pay off the loan? What's your plans? And we just had to address that. And they were very nice about it. They gave us the 6 months. I kept communicating with them. And they were willing to give me an extension if I needed to. I didn't end up needing that because, we were in good shape. But one of the beauty things in it is, like I said, on the FHA reverse mortgage, it's a non-recourse. So if the property goes upside down, where the value of the property is less than the lien, which doesn't happen very often, but it does happen. You could just give the property back to the bank and say, as the estate, we want nothing to do with it. Wash your hands, you're out.
Here you go.
Now, on the flip side, if the estate wants it and the value is less than the lien, you can pay 95% of the lien amount. So you actually get a 5% discount. I'm sorry, 95% of the property value, not the lien, property value. So you actually get a discount to value, and they write off the difference of what the lien is to that 95% of value. So that's what the insurance is for.
So if you had the property in a trust, that person who can inherit that property can, could they get a loan, another loan to pay off the reverse mortgage loan on that property?
Certainly.
Okay.
Yeah, we do that. We do that all the time. And here's another beauty that, is kind of, and this is a tricky one because I know we've got people from all over the country on the call, but in California, you really have to talk to AmeriState about the intricacies, because if one of the heirs, if one of the offspring wants to live in the property, take over the property and make that their primary residence, there are some strategies to make sure that you can take advantage of the Prop 13 and Prop 19 benefits. So you want to really, really be careful of doing that and doing it the right way, because if not, we've got a case we're working on right now, and it's with the AmeriState team that our client has a $930,000 property, and in California they're going to have a tax bill that's like $100 a month because mom's had the property for so many years. Otherwise, it would be like $12,000 a year, $1,000 a month versus $100 a month. So you got to do it the right way, and you got to get with Michelle and the team about that part of it.
Yeah.
Before they go doing other stuff.
Yeah. Super important. All right. Okay. So let's talk about, here's my show now, and step in when you want to make a comment, Ron, and maybe you could read some of comments here and we can answer some of those while I'm going through my thing. So sure. Let's talk about why it's important, again, to have a living trust. I see so many people do not have a living trust and they own property, whether they have a reverse mortgage or not. And I asked Ron the question, it just seems like people who get reverse mortgages never have a living trust. He goes, well, that's across the board. Most people don't. Oh, you're right. That's right, Ron. Okay, sure. And Ron is an advocate for living trust. So he tells his clients, if they come to him and they want to talk about a reverse mortgage, he'll go, and why don't you have a living trust? You need to have one. Most reverse mortgage lenders don't talk about it. I know this. They don't bring it up. And for me, it kind of boggles my mind. Why wouldn't they? Because it's a bad thing for the reverse mortgage lender if their clients do not have a living trust, Well,
I think it's the problem is there's so many people in general in this world, and in the mortgage world especially, that are transactional. Let's get the deal. Let's get it done. Let's move on. And they're not
muddy the waters. We want to get this deal done. I don't want to bring up anything else.
Right.
I want to get this deal done. I know. Yeah.
And even my forward mortgage people, even my young forward mortgage people, I tell them, we've got a case right now that I think they're in their 40s. And I said, okay, we just finished your loan. Go get your trust done, because, I don't know what areas everyone's living in, but there are people that got on the freeway today not expecting to die, but they did. And the living trust is the greatest gift anybody can give to their family. because when someone's grieving, do they really want to be dealing with probate and wills and just know where the package is and go and talk to Ameristate and get it taken care of, so that, because they've already had that consultation with the family, so they know what the desires are. It's all in writing.
Mm-hmm. Yeah.
And the other part that people don't think about is, my understanding is 80% of the people that have a trust don't fund them properly. So
Yep.
Again, you got to have professional guidance.
Right. No DIYs.
That's it.
DIYs. Doom. DIY. I always say DIYs. No DIYs. It's DIYs, or I call it doom it yourself trusts.
There you go.
And again, people, a lot of people on this video are clients of Ameristate already, so they know the value of what they have and what we've done for them. But for all you on here who have friends, family, just get out there and tell people and talk the talk, tell them, educate. It's all about education. So it does take 1 to 2 years to get through probate. The courts are so backed up, they can't handle it all. So just get in line like everybody else. So the family's sitting there going, okay, well, mom and dad didn't set a trust up, so we got to sit here and twiddle our thumbs for 2 years and not be able to take over the house or get access to their bank accounts. The courts are involved. We got attorney fees we got to pay out of pocket. It's hell. So don't let that happen to your family and your loved ones. So and estate plans it determines what happens to your stuff. I mean, you're on this earth collecting and buying and having families and purchasing property and toys and things like that, but you got to protect it with a living trust. That's just the bottom line. Anybody in any state, if you have assets, and I'm going to go through the next slide that is kind of going to go through who needs a living trust. But
Michelle, before you get there, there's a question here. What's the difference between living trust versus revocable trust?
Oh, it's the same thing. Well, it's a revocable living trust, and RLT is what 99% of the people set up for their estate plan. A revocable living trust. I just shortened it. I didn't put the revocable in there, meaning changeable, amendable, cancelable. If you set it up and you get divorced, it just, that kind of gets canceled, goes away. If you want to cancel it because you're just selling all your assets and moving to Europe, you can cancel it. But as long as you can only do it while you're alive and have capacity. If you become incapacitated or you pass away, you can't revoke it or cancel it. It's pretty much there, and it's there for your protection, so somebody can't come in behind you and start making decisions like, no, she's now going to give her property over here, and this person's going to get her bank accounts. So that's why it's revocable while you're alive and well, and it becomes irrevocable when you pass away or you become incapacitated. You can always regain your capacity, and then it will not be irrevocable. But that's why it's here to protect you if you can no longer make your own decisions or when you pass away. And it makes sure it goes to the people you love and have chosen and who you want to be in charge of settling things. The courts don't step in. They have no business in your affairs. It's not public. If you pass away without an estate plan or a revocable living trust, your affairs are public knowledge. If you just have a will, your affairs are public knowledge. So you want to have a revocable living trust. They're private. So that's another great thing about the living trust. Here's a little thing about who needs a trust. Not everybody needs one. I just set up a will portfolio for a client. His child is grown. He's retired. He has her on all his 401ks, IRAs, beneficiaries, and he's going to put her on his cards, but he still should have a will portfolio, because there's always those extra little things that happen when you pass away that you don't realize a will would have been helpful if he had at least a will. But if you have these types of things going on this slide in your life, you have minor children, you have special needs children, you own a home, you own businesses, you own second properties, you own land, you have children from prior marriages, you have, you become incapacitated. These are why you need to set up this estate plan. As long as you're 18, you should have something in place. So if you have not minor, but if you have young adults, maybe talk to them about getting their powers of attorney for financial affairs and healthcare in place. So that is the first thing you should do when you become an adult, is get those two documents done. And then as life goes on, maybe you don't have minor children yet, you don't really have a house or many assets, maybe a will portfolio is going to work for you then, because that will come with your powers of attorney. But once you start having those minor children, you better get an estate plan, a revocable living trust, because you don't want to put minor children on title with you to assets or as beneficiaries to life insurance or your 401ks. You want to put your trust on as your beneficiary behind your wife or husband, because minor children cannot receive money. It's a problem. So if you pass away and you have a minor child and you have their name on as a beneficiary to your life insurance policy, they can't receive it. So a conservator of that child has to step in. So it's very important to know these things. But a lot of people, they get their life insurance policy set up and they put their minor children on as the beneficiary. Guess what? That child is going to get all that money when they turn 18. That's it. And it has to be held by a conservatorship of the court over that child's lifetime until they turn 18, and then they get their $1 million. Yay, party! So that's why a trust is important for your children and minor children, and also your special needs children. If they're on public benefits, Ron, and they come into money because they were placed on as a beneficiary on something, that stuff's canceled for their, their housing or whatever they're getting as a special needs dependent or adult or a minor. They won't receive public benefits that they're getting that are essential to their well-being, So a living trust, just know that you need to get that. Okay, so and a little bit more about, here's some common ways people set up their estate plans. The most common ways, they do nothing. That's it. Okay, well, you've chosen that estate plan, and therefore the courts have the plan spelled out for you. And whether you become incapacitated or when you pass away, the courts have to decide how things go for you in your life. The next thing is people say, oh, I did my will. Okay, I'm good. Okay, well, a will still needs to go through probate. At least you have told the courts who you want to get your stuff and who's going to handle things for you. But a will isn't going to cut it for most of us who have the things I talked about before. And it's also a public document. Okay, so your affairs are not private with just a will. A lot of people add family to title. They think, okay, well, my husband passed, I need to make sure if I die that my house won't go through probate, so I'm going to stick Junior on title with me. We see that a lot. And for no other reason is it's the Band-Aid effect. So a lot of people do that. And what happens is when you die, Junior gets the property, and he's not going to share it with sisters and other brothers because you gave it to him, right? And then the best thing you can all do is get yourself a living trust, and especially if you qualify, like we talked about in the slide before. So with the do nothing plan, you go to probate. With the will, it guarantees probate, because if you have assets, your house is still going to go to probate with a will. Your minor children are still going to have issues because there's money that they cannot get a hold of because they're minors, and they're going to get it all at 18 once they turn 18. And then adding family to title, you have issues there, because what if Junior's on title and you decide you want to sell the house and move to North Carolina? He's going to go, sorry, I'm not going to sign that. So you lose control of your assets when you put your children on title to your stuff. You want to give them your assets through a trust. Don't give them ownership while you're alive. So here's what a living trust can do. You're going to avoid the probate. You create it while you're alive and feeling good. You don't want to do this when you start going, I'm not feeling so good. I need to go to the emergency room. I think I better set up my trust. That is the worst time you could be setting up a living trust. Do it while you feel good, you're well, life looks good. Get your affairs in order, because when things happen, they can happen very quickly in your health, and you are in no mental capacity shape to decide on your estate plan, and it's very stressful for everybody. We get those calls a lot, and we got to rush things, and it's really sad because we end up going to the hospital to deliver documents, and the people half the time we know aren't going to make it, and we're like, are we okay to even sign this? Does this person understand what they're doing? We're the notary, and sometimes the notaries have to walk away in those situations, and then there's nothing. So don't wait, is what I'm trying to say. Okay, so here's all the reasons to avoid this. It takes 1 to 2 years, seriously. That's how long it takes. And that's for a simple estate. You got a lot of more complex things going on. It's going to take years. People come out of the woodwork. They start fighting. They want more. They're not happy. Whatever's going on. So they start lawyering up. It can take many, many more years. Assets are frozen. You can't get access to the house. You can't get access to the bank accounts. Life is still going on for the beneficiaries, and they still need to pay their expenses and all this, and they can't. Somebody else is in charge now, and it's not somebody who you would like to be in charge. It's court supervised. It's pretty expensive as well. 6 to 8% of the gross value of your estate is what it costs. So if you've got a $5 million house, Ron, and you have a $3 million loan on it, it's going to be based on $5 million of the value. Not the value of that plus the bank accounts and all that. That's what the courts are going to charge, and the attorneys, and of course the courts are going to decide how your assets are distributed. Here's kind of an example of just 8% of a $400,000 estate is $32,000 just off the top before anybody gets the rest. So that's $32,000. That's a lot of money. Okay, so
Michelle, one of them that kills me all the time is if you've got that $400,000 property that you just mentioned, and there's a loan for 375, or maybe it's 400, you just bought it. You've got that 8%, and now maybe the estate doesn't even have enough money to cover it. It's not off the net amount, it's off the gross.
Absolutely, it's off the gross.
Big hit.
Gross. And that's including your house, your bank accounts, your boat, your airplane, your your toys. It's all combined. So it's this much after it's all, and everything's frozen because all the attorneys are in there going, okay, this is a good one. We want it. They love probate. They make good money. So stay out of probate. Don't give them money. They don't need it. Yes, they do, but they want it, but they're, whatever. So, and also you want to make sure that you don't go through living probate. I call it living probate when you cannot manage your affairs anymore. You become incapacitated, you have a stroke, you can't make decisions, you can't speak for yourself, and all of a sudden you don't have your powers of attorney for finance, and you don't have your healthcare directive. Nobody can handle your affairs. They are shut out of everything to manage things for you. It's really stressful, and the family has to go get a conservator, an attorney, $5,000 minimum just to hire them to step in and start managing, taking over. And the courts have to decide who's going to manage the estate now. And that person has to report, and it's money every year to pay. The conservator has to get paid out of the estate. So again, everything's kind of frozen when you are alive, but you can't handle your affairs. So nobody can talk to you, others, on behalf of your health care either, if you don't have a health care directive. So an estate portfolio, an AmeriEstate legal plan portfolio has all the things you need in case of incapacity. Let's see. Oh, when and how to begin the process. Okay, best time to begin estate planning is now. If you're on this webinar, now. If you already have one, great. Maybe you need to update it. Let us know. Maybe somebody's passed away and you need somebody to update that, review it. Let us know. Key life events: marriage or divorce, purchasing or refinancing a home, birth or adoption of a child, starting a business, inheriting money from a relative. These are all key life events that you need to make sure all these things are protected. And by the way, with those rates that everybody was getting on their refis a few years back, a lot of people pulled their homes out of their trust to get that great rate. And the lenders were so busy just transaction, like you said, Ron, it was all transactional, that they didn't care if that house got back in the trust. So you better make sure that you go and check your property's tax statements or pull your deed. When they refinanced that, did they put it back in the trust? Because oftentimes they made you take it out to refi. This is super, super important. That property will go to probate if you refied and you took it out and you didn't put it back in. Call us. We can help you. If you need that, we can pull a deed for you to make sure it's in or out of the trust. But I always say check your property tax statement. And if it says TR after your name on the address or trust or whatever, you know what's in there. Okay. So that's a good little trick and a little tip. Also, another thing, if you buy real estate after you've set your trust up, buy it in your trust. Put it in your trust. You open up a bank account, put that in your trust, open it up in your trust. Those are rules that you just need to remember as life goes on with a trust. You don't have to call and tell us every time you do something. Just know your rules. Protect those things from going through a probate problem. Okay, what living trust works best? Revocable is usually the best trust for most people. Some people get in some different types of trust, but that's for more strategic planning or very expensive, irrevocable situations. So majority of Americans need a revocable living trust. And this way you control everything. You set it up, you own it, and you control it. Just like you own your business, you control your business. And everything's private. If you pass away, nobody can get access to your estate information and who gets what. They can if all you have is a will, and they definitely will if you don't have anything at all. It gets published in the papers, and people can come out of the woodwork during that process. Come show up at court to see what Mrs. Smith had in her estate. So you want to keep that private. How much does a living trust cost versus going to probate? Well, here you go. Here's, AmeriState Living Trust is about this much, which includes the whole portfolio and some properties and the attorney consultation, notary and delivery at your home or in our office. This is pretty much what a traditional estate plan costs, $3,000 to $6,000. Probate court, and this is, well, traditional. I mean, if you're going to go you sit in the big leather chair at the attorney's high-rise office, they have to charge this much. They really do. Okay, this is how much they charge because it's mostly like a one-man band, and he's taking a lot of time to meet with you, talk to you, educate you, do the signing, this and they charge by the hour, $500, $600, $700 an hour now. AmeriState is a one-time fee. You know exactly what you're getting, and it's very affordable to make your changes and updates as life goes on. But look at this. This is how much probate costs versus how much getting an estate plan done. So it just makes sense, right? So, we're at the last slide, Ron. All right.
I've got some questions for you here, Michelle.
Okay, good.
Transfer on death, is that the same as putting another on title with you?
No, transfer on death is where you actually list a beneficiary basically on your bank accounts. So it's called a TOD. And there, in some states, there are deeds as well that you can do a transfer on death deed. AmeriState does not provide those or do those because we believe in the full estate planning portfolio, that you need to have this plan in place because it covers everything that you really need. So at certain times, there's a transfer on death deed where if you own it, you can put one person or maybe two people on as when I die is going to go to them, and that would avoid probate. But you have to be really careful you do it right, because, and not every state has that. I know California does and Arizona does. And some people do those, but I would see most people just have an estate plan, living trust, and they title that house into the trust because there's so much more to it. They've got if you put a minor children on transfer and death on a property, that's bad. You know, you need more flexibility. So
Does
transfer on death,
Ameristate do business in Texas?
yes,
Okay.
yes, we do.
Okay.
So we're in California, Arizona, Texas, Tennessee, Virginia, and Maryland. That's where we do all our estate planning, and all those states are community property states as well.
Yeah, I think we got them all.
Okay. And I don't know if there's any questions. We can go through some questions right now, Ron. If y'all want to stay on, I can go through those. And if you guys feel like you want to get off, that's fine. This will be sent to you as a replay, and that way you can review it again.
So here's another question that just came in on here. So, and this is about the reverse mortgage. So the best reversed mortgage on the traditional FHA reverse, the HECM, it's always better to do a adjustable rate mortgage if you can. And I know that sounds scary, but there's a lot of tax benefits to it. Again, I'm not a tax advisor. There are tax benefits to it. So the interest rate environment doesn't have as much impact, but where the interest rate does have an impact is that the higher interest rates will have a lower liquidity amounts. So in a lower interest rate environment, the liquidity amounts are higher. So I hope that answers that question.
Let's see. Richard Riva, lost audio. Can everybody still hear us? Give me a thumbs up, somebody. Okay. Can an irrevocable trust be used to move assets around to qualify for Medicaid 5-year look back? You know, the laws are really changing. Medicaid is, what state are you in? California does Medi-Cal, but it's all kind of the same, and every state has their specific procedures. Things are really changing in California, and we'll know more in January. Irrevocable defective grantor trusts were something we were doing, but things have changed and we're not doing those anymore. The best thing you can do is have your home in a revocable living trust. So if you pass away, the rule was, as long as your assets do not go through probate, Medi-Cal cannot come after it to pay off your Medi-Cal expenses, to pay things off if it doesn't go through probate. How does it not go through probate? It's in a revocable living trust, so they can't come after things when you're gone. But to qualify for Medicaid and Medicare, every state has a different program, and we would have to refer you to somebody who knows all the rules, because they change so fast that I can't keep track of it anymore. So I do have a good resource for you all here in California. Arizona is a whole new thing. It's called Alltech, and every state has their own program. Let's see here. Can you explain what liquidity means? Liquidity means your equity, right? Kind of.
So liquidity is going to be basically the amount of cash available. So when I'm talking about liquidity, is, you know, if you've got, you know, and Michelle mentioned this earlier, you have a house that's got, you know, say a $500,000 house, and it's free and clear, you can't go and spend any money because you don't have anything in your checking account. You know, you might, you know, other than whatever you had there before. So when I talk about liquidity, if I've got that $500,000 house, if I take a reverse mortgage, if it's the adjustable reverse, I don't have to take any money out, but I can write a check up to the amount available. So that'll change based on a person's age. If it's, you know, but at least you have access. The liquidity is basically access to your equity.
Hmm. And let's clear, you know what? I was Carolina and I were talking before this, and she was talking about a HELOC. I said, no, it's not a HELOC. It's a HECM.
Correct.
This is called
HELOC.
HECM.
Yeah, HELOC is a home equity line of credit, and a HECM is a home equity conversion mortgage.
Mm-hmm. And what's also really important is if you have your home in a trust and you have an AmeriEstate Living Trust and you want to go in and get that reverse mortgage, the reverse mortgage lender is going to say, I need HECM language in that trust, right?
Yeah, you have to have on any type of a loan, on real estate, you've got to have the language within the trust that says that whoever is controlling it has the authority.
Right. And AmeriEstate has that language in every single trust. It's very important. And that language was just added 20 years ago or so. And it's a needed thing. So a lot of people everybody who has an AmeriEstate Living Trust has a HECM language specifically for home equity line of credit loans. Let's see. Who else has a question? Hello, Richard. Let's see.
Do you do Arkansas? There's a question on there.
No. California, Arizona, Tennessee, Texas, Virginia, and Maryland. All right. There are lots of questions, lots of people saying hi. Awesome. I'm going to go down to the bottom and work my way up. And again, if you guys want to get off, that's fine, but let's see. Okay, Alan K says, Michelle is correct about incapacity and probate. Guardianship is the living probate. Yes, Alan, it sounds like you've probably been through it. We talked about that. No, Arkansas. I love Arkansas. The lakes over there, I heard. Awesome. I've never been. I'd like to go though.
Beautiful state.
Yeah. Did we talk about Joseph's? I had a client that passed away with a reverse mortgage but no will, so it went to foreclosure because the deceased had no will and bank would not discuss loan payoff with any of the heirs. Bam.
That seems a little that one there. I mean, obviously you had it happen. It sounds like there's probably some more to it. Generally what will end up happening is they're going to want some sort of payment as far as at least their interest money, because they really don't want the property. They want to know how they're going to get. Every lender wants the same thing. They want to know that they're going to get their money back and they want their interest. So they really don't want properties. So if they were getting paid, then they would generally work something out. But again, if none of the heirs wanted to make a payment and no one was communicating and they didn't feel like the level of comfort, that's when the foreclosure is really gonna take place on there. Again, they don't, because like I say, they don't want real estate.
Yeah. One more point I want to make is people who do a reverse mortgage, most of them will still have wonderful equity left over in that house when they pass. And that is money that can go to their kids or their heirs or their charities, whatever. That's a big chunk of money. So having a living trust will make sure that equity is going to pass on smoothly. It's a gift. So don't think just because you're getting a reverse mortgage, there's never going to be equity in your house. No, we know how prices are going up. I don't know what's happening coming up, but whatever. It's still, there's usually equity left over. So I get a living trust with a reverse mortgage or any mortgage. You're going to have.
In most instances, in almost all instances, so you're spot on there, Michelle, exactly right. So let's just use a number of, say you've got a $500,000 property and a $250,000 reverse. If that property is going up, say at 5% or 6% a year, which California, a lot of areas are at 5.3 is the average over the last 63 years. the property value is going up faster than the interest expense accumulation is going up. So the estate is actually growing faster than the loan. So you're going to have even more money to give away than you would if you just sold the property to live.
Yeah, it's important. There is equity in there. People think I'm not going to have any equity left. No, most likely you will.
Absolutely.
And don't let all that equity go to probate and attorney fees, because that's what will happen, and nobody will be left with anything other
Does
than
revocable
sadness
living
and
trust affect
frustration.
your homestead exemption in Texas?
I don't know.
Stump the master. We'll have to get back to you.
I think I know that, but I can't remember. I can get back to you. Let's see. Caroline, can you take her name down and we'll get back to her. I think Caroline can see all these later. Oh, I had another thing I've always thought this about, and I've had this come up, Ron. I have a married couple. The one is, in their 50s and the guy is 62. So he gets the reverse mortgage because she can't, but they're married, right? No?
Nope.
How does
No,
that work?
that was something that actually stopped. So it
Oh,
was being
good.
done a lot. And, one of the things that we hate seeing is people being homeless.
Okay.
So what was happening was you'd have the exact scenario you're talking about. A 60, 65-year-old marries a 40-year-old. The 65-year-old goes and gets a reverse mortgage. Well, likely is that person's going to pass before the 40-year-old. So they pass on. Now the 40-year-old has to settle the reverse mortgage. They have to either refinance it or sell. And they're saying, well, we want to live in the house. Well, sorry, if you can't afford to settle, if you can't afford to get a new loan, if you don't qualify, then you have to sell or the property is going to get foreclosed upon. So under the FHA, they stopped that. So they actually will look at the youngest person that is on title, not on the loan. And in a community property state, they're going to look at the community as well.
Awesome. I didn't know that.
Yeah, it was a protection that was put in just because there was people trying to do the reverse, and then someone was
Yeah.
being left homeless. We don't like homeless
Yes.
people.
Yes, that was a kerfuffle, and that came
Yep.
up. I've been doing Ameristate for 27 years, and I would hear the stories back in the day. I'm like, oh my God, this is awful. What in the world? This is crazy. They're married, but she's getting kicked out of her house. Just isn't right. So I just thought that was so weird. One more question, and then we got to go because we're after 12 o'clock, and we still have 51 people on. That's awesome. My shoot, I just forgot the question. Ah. Oh. Are all reverse mortgages FHA?
No.
Okay.
So there are reverse mortgages that are a smaller amount. FHA is going to limit the amount. So the vast majority of reverse mortgages are FHA, but there are some that are portfolios. So the reverse mortgage second is not an FHA product. And when you start getting up into the higher loan amounts, those are not FHA products. So like I said, the one that I did that was a $4 million reverse, that was not an FHA product. Follows a lot of the same rules as the FHA product, but it is not an FHA product.
Got it. Okay. Sounds good. Well, we're gonna bow out now, and thank you all for staying on for over an hour and getting through my technology issues. I'm so glad. I have no idea what happened, but I'm just glad to be here and it all worked out. I appreciate everybody so much, and reach out if you have any questions. And again, we'll send this recording to you. I think Caroline pretties it up and it'll be in your inbox next week. All right. Take care. Thanks for joining, Ron. Call
Thank
Ron.
you.
Here's our numbers. If you need anything from Ron, give him a call. He's the best. Okay.
Appreciate it.
Okay, bye. All right.